Hello, this is Joe Pryor of the virtualrealestateteam.com in Oklahoma City. I read another article the other day. I always read a lot of articles on investment real estate as well as just articles in general, but this one was an article based on what they call the 1% rule. Now, the 1% rule in residential is kind of like the 10 cap or 10% capitalization rate in commercial. It's kind of like, well, if you can get 1%, which is buy a house at $150,000 and rent it at $1,500, you should absolutely buy it. And that's what the article was saying, except the article's wrong, mainly because the article didn't quite get down into the details. And if you're an investor anywhere in the United States, there's a lot of detail that you need to really look into. Number one, what are the taxes for that area? Just to give you a contrast between Oklahoma and Texas, in Oklahoma, the taxes on a house like that might be around $2,200, $2,400 a year. But in Texas, it's going to be double that. It's going to be around $4,800 a year. So in other words, say about an extra, at least an extra $200 a month that you're paying in taxes. Now, if the rents are the same, of course, if it's 15 and 15 in Oklahoma City or Tulsa, then basically that affects that 1% rule quite a bit. The same thing goes for where you buy. For instance, I own property in Oklahoma. I also own property in Florida. And I can tell you in Florida, my insurance, because it's located close to the ocean, is about 3 times higher. So that can affect the 1% rule. I'm also in a state that on certain types of rentals charges a total of 12% tax on the rental amount. And so there's a county tax and a state tax. That can affect things. So insurance can affect it, taxes can affect it. Vacancy can affect it. If you're an area of high vacancy, then whatever you see on paper on that 1% rule, if you have a 20% vacancy rate versus a 5% vacancy rate, then that also makes a very, very big difference. So taxes, insurance, all of these things that I'm talking about will affect you. What if it's in a condo, for instance? What if it's something where versus a single family home, you're paying $100, $150 a year in the homeowners association, whereas you may be paying $300 a month in a condo fee. Now, some of that's going to be for insurance, but only for the exterior part of the building, so you still have insurance. That can affect the 1% rule. What I'm saying is, wherever you buy, be it Oklahoma, Kansas, California, Phoenix, anywhere that you go, don't buy on a 1% rule. Do not buy on a cliche or some article that somebody wrote that they got published. Buy in terms of getting down into the details so that you get all the information that you need. Because remember, anytime you put your money out, it's a risk. I don't care if it's the stock market, I don't care if it's mutual funds, annuities, real estate, whatever it happens to be. Las Vegas, you can put all your money on red, and if it hits, you're great. If it doesn't, you're broke. So all these factors have got to be put in there. So make sure that you're working with someone that's going to give you that type of a due diligence. And if they use the term, you should buy this, it's a no-brainer, run like crazy. I hate that term because it basically means they don't have the details to show you. And without those details, you should not be buying. Remember that the rule is return on investment, how long you hold it, how much risk there's involved, and all those details. This is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.